Welcome to another session in accounting and finance where we're looking at debits and credits. So this session is going to be an exciting session because we're going to look at debits and credits. So it's debits and credits. Debits is receiving, credits is giving. Debits is receiving, credits is giving. And our objective is to be able to understand the principles of debits and credits. By the end of this session, you should have a better understanding of debits and credits. So we're going to look at the two main statements. First statement is the income statement, and the next statement is the balance sheet. So the first statement is the income statement, the next statement is the balance sheet, and we're going to look at the income statement with debits and credits and the balance sheet with debits and credits. So in the income statement, you have income and then you have expenses. So income statement has income and expenses. So income are credit accounts. Income accounts are credit accounts and expense accounts are debit accounts. So income accounts are credit accounts and expense accounts are debit accounts. Now some examples are the sales account, which is a credit account. Rent income account is a credit account. A service income account is a credit account. So all of these accounts are credit accounts. Now in terms of expenses, expenses are debit account. So rent expense is a debit account, salaries is a debit account, wages is a debit account, advertising expenses are debit accounts. We move on to the statement of financial position. So in the statement of financial position, we know we have asset is equal to liabilities plus capital. So we need to distinguish the various accounts. The first account we'd like to look at here is the asset account. The asset account is a debit account. So the asset account is a debit account, the liability account is a credit account, and the capital account is a credit account. So the asset account is a debit account, liability account is a credit account, and the capital account is a credit account. Now let's look at some examples. So an asset, as we said before in a previous YouTube video, is car, house, money. So these are debit accounts. In terms of liability, the loan, credit cards, etc., those are credit accounts. And capital is a credit account. Okay, so assets are debit account, which is car, house, money. Liability, loans, and credit cards are credit accounts. And our capital account is a credit account, which is the owner's investment or partner's investment. So to conclude, we've looked at the income statement, we've looked at the accounting rules surrounding it, which is the income statement has the sales account and all the various revenue accounts, which are credit accounts, and the expense accounts, which are debit accounts. And in terms of the balance sheet, we've looked at it. We have assets, liability, and capital. In the balance sheet, the asset account is a debit account, the liability account is a credit account, and the capital account is a credit account. If you understand these principles and rules, you should not have any confusion in terms of doing double entry using the zero accounting software or any accounting software, because these rules are universal, and once applied, you will have a fantastic time doing accounting. Hope you enjoyed this video and subscribe to our channel. Thank you.